you think that investing in REITs is a waste of time?
So let's say if you are very rich, like Eric, you can spend money, buy a few condos and then rent out. That's also real estate investment.
I don't know. I'm starting to hate REITs a bit.
I think in today's episode, we are back with another banger topic. We want to talk about all-time favorite in terms of a Singapore investor portfolio, which is the REIT investment class, real estate investment trust. So I think specific to REITs, there are many considerations where some people are looking at it as a valuation play because of the potential upcoming rate cut. Some people are looking at it as a dividend play because they want to maybe potentially receive passive income and they need some sort of investment instrument that gives them this so-called 4 to 5% returns in the longer term with a larger capital base. On the flip side, you also have another group of investors telling you, hey, why waste time on REITs? REITs, they don't have potential to grow. And even I think recently in the Singapore finance scene, I think AK71, he has been a strong proponent, or he has made that argument that when you look at the two big investment types, which are both big dividend players, which is namely your Singapore banks versus your Singapore REITs, the banks are paying out 50%. They have strong tailwind, they have great growth prospects, they have a strong balance sheet. And at a 5% yield, because they're only paying out 50% of their earnings, means that their earning yield is right around 10%, compared to the quote-unquote lame 4 to 5%, and the REITs are paying out close to 90%. And whenever they want to expand their portfolio, then they need to raise funds again. And I think for a retiree perspective, might not be good for them to keep plowing in additional capital to upkeep with that amount. So I think we just wanted to really go deeper into the discussion and to really understand from the different points of views on what you guys think about REITs and how do we decipher this whole investment class. So I think just to set up the stage for BoonTee, it seems like he's intending to build up a sizable sum, maybe to position for his retirement subsequently. So I'll just give the time or give the stage to BoonTee to talk more about this REITs asset class.
Not going to have a sizable REITs portfolio. I think REITs is like, as I think about my retirement, right? If look forward, let's say like 10, 20 years, so that REITs they can produce some cash flow. I think that's very helpful in terms of retirement, in the sense of like cash flow planning, not in the sense of like total return view. Because I think that total returns still, I think a lot of like non-dividend paying REITs or banks are better. If you just look at STI, I think it's like almost or around 50% is all Singapore banks or financials. And then the other part that Singaporean investor really like to invest in is REITs. So now we are just having a focus view on these two, which one is better. I have to recognize that the Singapore banks, right, in terms of their fundamentals, in terms of the bank's financial results, their dividends keep on increasing dividends, and yet their payout ratio is still quite decent. That means they're paying decent amount as dividend, but they haven't really paying out all their earnings, meaning that there will still be retained earnings that can help them grow in the future. So I think judging from results wise, right, I would say that banks is really superior. But your questions to me is like, then why bother with REITs investment, right? So I have go through a few pointers which we can discuss in more detail. But I think if I were to summarize all these pointers, right, I think comparing these two, if you are someone who is like really want to go all in for the growth, go all in for the returns, right, I think banks is the better one. But let's say if you foresee that we are going into some sort of recession, market slowdown, then I think because during market slowdown, right, interest rate will tend to go down because central bank, they will do some easing, those kind of things, right? And as that happen, right, actually REITs will benefit more from this kind of monetary measures. So I think in that sense, right, if we foresee that there will be some slowdown, I think REITs will perform better as compared to banks, because banks, they have to deal with all the non-performing loans and so on.
Is it right to say that I think banks are more cyclical in nature? So if let's say we don't know what will happen in the future, right? So let's say using at this current point in time, you're saying that if let's say we are really going into a down cycle, touch wood, hopefully nothing happens. But if we go into that from a total returns profile perspective, the banks will tank a lot more compared to the REITs. But REITs will still probably go down, is it?
It tank, I would say it tank a lot more. It will tank first because bank will go down first, so it's harder to react. Whereas let's say if you hold other lagging sectors, right, you have more time to react to it. But banks is actually the ones that's going down first. So it's actually taking more risk by investing in banks.
Okay, understand. So maybe Kelvin, on your perspective on, I think some of the few key pointers, right, where you say that dividend is irrelevant, the REITs are flimsy in nature, they pay out everything, there's no growth prospects. I think shareholders also, I think from Eric sharing, sometimes, or actually a lot of times, shareholders get screwed by lousy managers. So what's your perspective on this, and do you think that investing in REITs is a waste of time?
No lah, of course not. It's not a waste of time. For retirements, this income makes sense. So the reason I say it's irrelevant is because if you're in your 20s, in your 30s, you $20, $30 dividend every year is not going to help you at all, right? So rather it'll be much better to just reinvest the money back. In which case, like you incur all kind of commission trading fees lah. But for BoonTee, since he's going to use it for his retirement, he's not mostly, hopefully, not going to reinvest the money back. So in that case, this REIT dividend is relevant lah. I'm more curious about, right, BoonTee, what kind of REIT are you looking at? Is it like Singapore REIT? Is it like ETF?
Yeah, for REITs, we are talking about Singapore REITs lah. Definitely not US REITs. Exposure-wise will be similar to ETF. It's just that you can buy the individual REITs yourself. There's some benefits of doing using that route lah, meaning holding individual REITs.
Okay, so in that case, why REITs in particular? Why not like, let's say, SGX, or like, let's say, Sheng Siong, or REITs? Like you say, the payout ratio is so high that they have to keep issuing rights to get more capital.
Yeah. So I think let's take a step back, right? Because if you look at REITs, they are essentially real estate holdings. So let's say if you are very rich, like Eric, you can, spend money, buy a few condos and then rent out. That's also real estate investment. But let's say if you are, like small investor like me, so you can just, okay, I have 3K here, 5K here, then I will just buy some REITs, get some dividends, and you can continue to put money into all this investment and then take the dividends, reinvest back, and then you can build a dividend portfolio that is growing in terms of the dividends every year. So that's something that is very doable for everyone. Partly it's also diversifications, because let's say if you already invest in S&P 500, those are really mainly corporates, right? So we are investing in business. So you are taking business risk. But if you invest in REITs, basically you are indirectly holding all these REITs assets portfolio, which are real estate portfolio, and then from there you are actually deriving rental income, and there's some leverage built into it because REITs they usually have some leverage, right? So that part I think is done on a very reasonable level for Singapore REITs. So and from that you can get quite a stable cash flow, because they can't they are obligated to pay out certain percentage, like I forgot, like 90% of their rentals, right? So you have some stability there. So I think that's why REITs have some, attributes or properties that people like about it. It's mainly about the cash flow part.
Given this recent drawdown, right, I just wanted to ask Eric, do you have any reflections? At least, I think you're one of the biggest REIT holder of the four of us, lah. Do you have any reflections or any like pitfalls you want to share, or any lessons learned through the last 3 to 4 years about your REIT investing journey?
Actually, this REIT investing, right, I think it just feels good from an investor point of view that every quarter you get some sort of an income back. But the drawdown, you can see is very real, like comes. And then I will argue that the earlier point that BoonTee made, right, that when there's a drawdown, the REITs actually give you a little bit of time to react. I would say that holding REITs for the past few years, right, anytime the market smell a rumor only, the REITs start crashing. Like it's not even official yet. They just rumor that the rates will go up, right? Wow, the REITs, everybody crash 10% first. When it really comes, then crash another 10%. So total is 20%. But I think it's not so clear cut, yeah. Like sometimes when the Fed cut rates, right, they say it's bad for the banks, right? But then they will argue that, then they can lend more. The portfolio will build faster. So I don't know. I think that banks have a bit of a buffer in terms of the dividends payout and everything compared to the REITs lah. I mean, 20 years ago, this is definitely this argument wasn't really very I would say popular. Yeah, REITs are like, wow, the king of the game. Back when I was like a stockbroker lah. Everyone's favorite was like buying REITs. There's a correction, buy more. Then after that, you can wait for it to come back. But nowadays, it seems to be on a grinding downward trajectory. Anytime there's a rebound, you grind back down.
Because people tend to remember, they have this recency bias, right? Where I think previously REITs were doing quite well. I think
Yeah.
even in my father's times, everybody's talking about reinvesting. And then recently, like over the last 3 to 4 years, we have seen the different confluence of the factors, right? And banks have been significantly outperforming and carrying the entire STI. And that's why everybody's saying that now the banks cannot fail. Now Singapore big three banks is like the crown jewel of the whole STI. So which begs the question again, how do we do the analysis, right? So I know BoonTee, you prepared a simple deck. Maybe you want to share a little bit more in terms of your perspective and your analysis of both types.
Yeah, we can go into the deck in more details, but I think one thing I want to highlight is that comparing banks versus REITs, right? I think the one thing that is very important is that where do you think the interest rate be? Because if you think that interest rate is going to stay at current level, stay high, not going back down, like let's say 1-2% from current level, right? If it stay high, then banks can continue to go up, because they benefit from higher interest rate. Whereas, let's say if you think that we are going back down to like low interest rate environment, say for example from 2010 to 2019, right? That kind of period, then REITs definitely win because REITs they benefit from lower interest rate, right? Because they themselves are leveraged, they borrow money. If you can borrow at a cheap interest rate and then invest in real estate, get your rental and then pay out your dividends, that's really great for the REITs investor lah. What we are going to do is just flip through some pointers and then we can discuss in more details. So this is something that I prepared beforehand. So just now I mentioned about the pro-cyclicality, meaning that if we are going to continue to have this kind of growth, meaning that more rich people come in Singapore buying all this, housing, and then banks can just loan up with a good, interest income. I think that will be great for banks. REITs dynamic will be a bit different. Then about the leading indicator I already mentioned. So we will just fast forward. Interest rate dynamic, just now I just mentioned. So just remember, if interest rate low, good for REITs. Then for banks, it's the other way. This is just how it works. Just the dynamic or the nature of the business. Which one we haven't mentioned before? Let me go. Okay, I think this one we discussed in the past, but just now we didn't mention. I think for banks, right? You need to remember banks can really lend out a lot. But in terms of how much capital they keep within the banks to buffer against potential losses, right? It is just a fractions. That means, let's say the non-performing loans goes up to a certain percentage, right? It doesn't need to be like 80 or 90% of their borrowers go default. I think just a small percentage increase in non-performing loans can really, destroy their balance sheet, meaning that the equities will wipe out easily. I think this one happened in the past, let's say for US banks, but for Singapore banks, I would say that they are very resilient, and at least in terms of borrowing standards, everything, they manage their balance sheet in a prudent way. So I don't see this as a big risk. But just remember that the leverage, right, is always part of the bank's business model. So this one also is like you're investing in banks, right? You're getting a higher returns, but just remember that those are actually the risk premium because of the risk that you are taking.
I think one very common argument in the space now is that when you're investing into banks or you're buying to their valuations today, they are fully priced, if not overpriced. But when you're buying into REITs as an asset class today, assuming that you use price to book, you look at NAV, they are usually underpriced or they're even like fairly priced at max. Even you look at good REITs lah. But most of the time, I think a lot of people will argue that they are underpriced right now. So if I come in with the mindset that I want to play on a valuation, meaning it's a valuation play. Let's say I just Googled, I think the CFA REIT ETF, they are currently trading around 20% discount to book. So assuming that I buy today at 0.8 book, it means that there is a 20%, assuming normal scenario, nothing happens, economy still goes, chucks along, interest rate comes down, there's a valuation repricing. Is it safe to say, or is it like a fair statement to say that we can appreciate this 20% in terms of revaluation on top of your 4-5% expected dividend yield moving forward?
I just think that market is pricing in very effectively already, like based on the circumstances. So unless there is like a change in the interest rate or whatnot, then you can kind of reprice the whole thing lah. Yeah, I think some people have tried to do this, like 50 basis point increase in the interest rate will cause a correction of how many percent in the REIT. It will affect the REIT earning to that percentage, and hence probably affect the price to that extent. So I've seen some people do that before, but I don't think it can be applied across the REITs, and I also don't think it's very accurate outcome for that REIT that he was projecting for. So who is to decide like what is the true valuation, right? Like you say 20% discount, like who actually decided?
Based on the book law, as in based on the asset value of the REIT, and then they say that 1 times is fair law. As in this has been the conventional wisdom
Yeah,
that
I
you
know, I
should.
know.
Yeah.
But if you really go and sell all the assets, right, you may not get that valuation. That's just an estimate. So
Yeah.
if you go and sell it, it may be very depressed now because, as you know, a lot of the all those like work from home and all those trends really affected the business parks. So I think
Yeah.
there's a lot of downward pressure on the various types of REITs. The only REITs I know that's like surviving okay is the Maple Tree Industrial Trust.
Just add on Eric's points, right? So basically, there are few things, right? Because when we say that, okay, what is book value, right? Actually, it's just like, although they have to, get some auditor to opine on the book value, meaning that it cannot go too far away from the market prices, but essentially all these REITs, like their portfolio value, right? It is not, like traded like stocks on the exchange, right? Like you have daily transactions. These are actually illiquid assets. You want to sell your building, you still need to check whether there's buyer or not. This kind of situations, right? So and then their value is like actually their value also fluctuates. So there are a few layers. The first one is that REITs itself, right? They are borrowing. So they have to pay interest on those borrowing. So let's say interest rate is higher, lower, they have to pay. So that will affect the dividends directly. So that's first layer. Second layer is that if you just look at the book value, right? The book value, the market value that you saw in the balance sheets, right? That values also depends on interest rate. Because say, for example, when interest rate was like 3% over some period already, the PE or you call the PE, but the E is actually the rental incomes, right? The PE that you will assign to all these buildings is, let's say, X amount. But let's say when interest rate is no longer at 3%, but at 5%, you won't assign the same value, right? So that one, just because interest rate went up, their valuation also have to come down. So have you fully reflected those? I pose it as a question because I believe that they have adjusted it down, but is it fair or not? Is there some qualitative judgment there? So that's another layer. And then the third layer, which Eric just mentioned, is that like the actual quality. Like let's say if you look at their occupancy, right? Maybe pre-COVID they are like 95%, but now after all these like work from home situations, you better check the occupancy rate. It could be at yeah, 80% and no signs of improving. I think there's some news before this, right? Like for example, like Changi Business Park, they still struggle to get tenants come back. I think it affects certain REITs that we can't discuss every REITs because they invest in different geography, different sectors, different segment. But generally speaking, there are some REITs that struggled because they can't get tenants. Or their tenants is so good at negotiating the rental, they cannot keep the rental rate, they have to give discount. So these are the things that we need to focus on. So REITs have their own challenges.
All things considered, I think Kelvin, you are around BoonTee's age, right? Will you be interested in building a REIT portfolio anytime soon?
No lah, I'm not. I think for BoonTee, he's the kind that wants to like play it very safe, right? Portfolio diversification, he has like perfected this art. I went to check REITs versus like the all world index fund. The all world index fund outperform REITs. Don't have to focus mainly on REITs, like you can also like diversify elsewhere. For REITs, I don't know, it's too dependent on interest rate. So if you were to during retirement and the interest rate suddenly go up, then that REITs part will be like, oh, GG lah. The all-weather kind of dividend stocks lah. So like SGX, Heng Xiong that I mentioned earlier, because in recession, good or bad, the economy good or bad, people will still go to shop, go to trade on the markets. Then or if you don't want that, you can look at those global index fund like VWRA, those kind. They are more, it covers everything. So I don't know. I'm starting to hate REITs a bit. Not hate, right? Starting to not look at REITs so much. Yeah. But if you want to look at REITs, you should go for those that are more resilient. MIT was what Eric mentioned just now. MRT was one of it. Fraser Centerpoint, another of it. And the big ones like CICT, this kind. Personally, I don't really like to do this like interest rate down. I'm targeting these REITs. These REITs which will benefit. I don't really like those because I can earn money elsewhere. Yes.
I want to survey you all because you all know that this RTS is going to be completed in, I don't know, 1 or 2 years time, right? So there are people who speculate that, oh, after RTS is done, Singaporean will just go to Johor, do their shopping, and then they spend more time in Johor, right? So my question is that, let's say this one doesn't affect office REITs, I believe. It mainly, we're talking about retail REITs, more REITs, right, in Singapore. Let's say if you have more REITs, will you be concerned of this development?
Actually, I was more concerned previously when we were just onto the hype about internet shopping, like Shopee, Lazada, all that. I was a bit more concerned because those are more instantaneous. Because if you understand, I think there was one book we read before, right? If you cater to people's appetite, cater to their laziness, cater to their need for entertainment and some other things. So if you cater to these few things, right, your product confirm make money. Yeah, you make it convenient for people, you make it cheaper for them, and you satisfy their appetite or whatnot. Yeah. So the internet banking, right? Internet shopping. That era, I was a bit concerned for the REITs, the retail ones. I was thinking like, if people can click online, then why do they need to go out anymore to the shopping malls? So I think as the thing played out, I realized that even for myself, I buy online. Yes, I do buy online, but that doesn't stop me from consuming elsewhere. But of course, certain segments of the REIT itself, the tenant mix actually changed. They shifted towards the F&B side a little bit more, and the in-person services like massage and all these things. Johor thing, right? To answer your question, I think it will be even less of a concern because yes, the people who want to go there will still go there. Yes, I have friends who like they drive up like once a month or something, or once every 2 weeks, or if they live in Woodlands, they go out like every weekend. Cheaper their money instantly times 3 point something. So the people who go up, they will still go up. But if you ask people like Kelvin, would you go up? Like there's a MRT at the, you won't, right? I also won't. Like if the thing I can find it at Tampines, I won't even bother going down to Orchard. I mean, some people will and I think that's the draw about the suburban malls. They have very strong footfall, despite the fact that you have possibly more variety at the the Orchard area or that, but we like lazy to travel so far, like 1 hour there, 1 hour back. I might as well just shop around my area, the interchange. I can get like 90% of all the things. Then the 10% that I cannot get, I go online and buy. They deliver to my house, less than $2 shipping fee. So if you ask me, am I concerned about the Johor Linkway? Not really lah. Maybe people will make trips, like maybe once every half a year, a family outing or some sort like that, but not regularly. I don't see it as something that will affect footfall very much.
Let's say chicken, or will you be concerned?
Not concerned.
No concern because you didn't invest in REIT.
I mean, I'm personally, I do go to JB often, but not often enough. Not like once a month or once a week, that kind of thing. But maybe once a quarter, once per 6 months. Still, but one thing I realized, like what Eric said, right? I also realized some of my friends, right, is those people that drive then go. So actually, technically, it's those people that can afford a car. You can afford 100,000 COE, then you go to JB, which is quite ironic. Because anyway, if you go and squeeze, right, meaning you take Woodlands and then you go take the bus, right, it's gonna take a freaking long time to go past the whole thing.
But
It's at least
RTS would change things, man. That's it make it a lot more convenient, right?
so it becomes a day trip, right? You wouldn't go there, buy already, then come back, right? Even though it becomes more convenient, are you gonna spend 3-4 hours to save $50? I don't know lah. Maybe some people really will spend that
Yeah.
3-4 hours to save $50 lah. But
Yeah.
at least for myself, I'm not their target audience lah. So I'm not I would just think that a lot of these consumption patterns, it will change lah. It will morph and business will find ways to attract different type of people lah.
For me to make a trip up there is quite torturous. But I think for people like BoonTee who stay at the red line, maybe you make more trips, stay at the red line. I don't see you go to Orchard that often also, even though it's in Singapore. So now that it's more convenient to go to Johor, same thing lah.
Then can I ask, I think just last question for myself, right, on these big banks versus REITs. Because now I'm also a bit torn. I don't have a big exposure, but I do still have a few $1,000s in REITs, right? And I keep asking myself, actually, what's the point of holding on to? I do look at it from a valuation perspective, as a valuation play, meaning assuming interest rate do cut and there's some sort of a rebound, then they should all sit on pretty healthy gains, which we saw momentarily, and then it crashed back down again because of the whole after Trump election, then they say it's inflationary, right? So I'm asking myself that question, which then goes back to the point of, like you said, and I do agree with you that banks are more superior in terms of the business dealings, and even though I think valuations might be slightly pricier, the market is pricing in additional like premiums. Then I'm asking myself the question, and then I'll extend the question to you that since bank is the more superior company or they are superior like investment type, why not just buy banks? Why waste your time with REITs?
Yeah, this one, imagine, let's say, maybe you look at it like few thousand or 10,000, you don't see the overall picture. Now imagine you are, let's say, 45 years old or 50 years old, right? And then instead of like 10,000, now we're talking about 200,000 or 400,000, that kind of sum, right? Actually, for a retiree, I think the biggest risk is not like, oh, some, like fluctuation in terms of the price and so on. It's not about that. It's more about like, now you have some of money, capital invested. For them, right, it's like they will be afraid that, let's say, interest rate just come down, and then their bonds, let's say they have some bond holdings, right? The interest rate, the reinvestment will become lower and lower. So you have the capital, yes, but you can't generate a decent yield. This is actually the environment that was faced by many retirees from 2009 until 2019, right? Even after COVID, also is a similar situations. So for those who have bought into REITs, right, they actually lock in the yield because it's quite a decent yield as compared to other alternative during what we call the zero interest rate environment, right? Risk management perspective, lower interest rate is their biggest risk. So, and REITs provide a good hedge for that kind of situations. So back to your situation is that if you that's why I say you need to look at it from a factor perspective, because if you're scared of interest rate become lower, I don't know whether you still recall, maybe you haven't really investing for long period of time during those low interest rate environment. Everyone was complaining, wow, the yield is so low, my bonds mature already, I take the cash, I don't know where to put, I put here, put there, only 1 or 2%. So it's really, really challenging to manage your retirement in that scenario, and REITs is a way out now. So the question now is that, are we going back to that environment or not? If not, right, then I don't think you should continue to bet on REITs if you think that yield will stay high. And by the way, if we talk about the REITs performance, right, it came down for quite a period and then go up and down again, right? If you pull out the chart, right, you just mirror that chart versus TLT, right, or some long-term bonds prices, right? Actually, they go quite consistent. That means they all come down together. When you go up, long-term rate you go up, their price come down, so REITs also come down. So they are like a long-term bond. It's just that long-term bond is not like, let's say there's inflation, so it doesn't benefit from that. But for REITs, there will be some benefits because it's a kind of like inflation hedge, right? Because if inflation is high, then all these REITs, they can charge a higher rental. So that's something good as compared to long-term bonds.
Which begs the second part of the question, right? On is it good to hold on to this past mindset where last 20 years and you think that that's the norm, or
short-term wise, I would say that probably you will stay high now. But you know, this kind of predictions, I got it wrong for 3 times already. But that doesn't stop me from keep making predictions.
Even the Fed is projecting interest rate long term will go down. So I don't know. Even when interest rates high, the REITs are already giving a good steady dividend yield. So what's more when interest rate go down? So if you want, then REITs is a good part in your portfolio when you really need the money lah. So
With that, we'll see you guys in the next video. And hopefully, and please remember to help smash the like button. And yeah, we'll see you soon. Bye.